We've mentioned that all of the different QMs established by Regulation Z have a points and fees cap of 3% for loans of $100,000 or more, with a tiered scale allowing higher caps for smaller loan amounts. We've listed the breakpoints for the tiers for this year and the applicable points and fees cap on the slide. These are adjusted annually. Here are a few points we'd like to highlight. First, the components of points and fees are, for most lenders, a variation on a familiar theme. If you've been doing consumer lending, you've already worked with the Truth in Lending finance charge rule. If you have good systems in place to comply with the finance charge rule, you've already gone a long way towards understanding points and fees. Second, though people generally refer to a 3% cap, there is leeway in that figure. There are a number of important exclusions, charges that need not be counted toward the points and fees limit. Generally, fees that are paid to unaffiliated third parties, such as appraisal or title-related fees, are not counted against the 3% cap. Likewise, up to 2 bona fide discount points may be excluded. Glenn, can you discuss this in a little more detail?
Sure, Elizabeth, I'd be happy to. For most community banks, the category of points and fees that will probably be most relevant to you is the one that consists of prepaid finance charges. That's the first of 6 categories of points and fees listed in the regulation. Identifying prepaid finance charges is something already embedded in your compliance and training systems. That's the first step. However, not all prepaid finance charges count toward the points and fees cap. Some prepaid finance charges are always excluded from your points and fees computation, and some additional prepaid finance charges may be excluded under certain conditions. The types of prepaid finance charges that are always excluded from the points and fees calculation for QM are daily interest or other interest, government guarantee fees such as FHA upfront and annual premiums, VA funding fee, and the USDA guarantee fee, and all monthly private mortgage insurance or PMI charges and premiums that are payable after consummation. By contrast, upfront PMI charges must meet certain conditions in order to be excluded. Elizabeth, can you help discuss some exclusions that may apply?
Sure, Glenn. There are some conditional exclusions that may apply when calculating points and fees charges. Prepaid finance charges may be excluded from points and fees as long as they are payable to bona fide third parties. That is, the third party must be unrelated to the creditor, loan originator, or an affiliate of either. If any part of the charge is retained by one of those entities, the portion that is retained counts toward the points and fees. If you, as the creditor or your affiliate, are just acting as a conduit to pass through these upfront prepaid finance charges, they do not count. So for example, if the charge is $50 and you or your affiliate keep $15 of it, then $15 counts. But keep in mind that there's a limit to this bona fide third-party exclusion. If another part of the rule requires that the fee be included, then that trumps this exclusion. For example, upfront private mortgage insurance charges are commonly paid to an unrelated third-party carrier. But there is a separate provision of the points and fees rule that applies different conditions to upfront PMI. You must look to those conditions to determine whether upfront PMI can be excluded, and if so, how much of it, even if it's payable to an unrelated third party. You can find those conditions in the rule itself and in the CFPB Small Entity Compliance Guide.
A maximum of 2 bona fide discount points also can be excluded. Whether 1 or 2 points can be excluded depends on the APR on the loan, as you can see on the slide. To be bona fide, they must actually buy a rate reduction for the borrower and do so in an amount that is consistent with industry norms. If the charge meets both of these conditions, then it is a bona fide discount point that can be excluded. To show compliance with these conditions, you will have to determine the base rate that the consumer would get for that transaction before the discount is applied. Remember, there is a 3-year record retention requirement under the ATR-QM rule. Your policies and procedures should be sure to include a way to retain documentation of the base rate as part of that.
Let's just touch briefly on a few other highlights of the points and fees calculation rules that may be most likely to affect your business. Sometimes third parties other than the creditor may pay some of the upfront charges. For example, an employer may pay some of the loan charges as part of a relocation benefit. Generally speaking, those are treated as if the consumer paid them. That is, if they would count when the consumer paid them, they count if a third party other than the creditor pays them. However, if the creditor pays those charges, they are excluded from points and fees, with one exception: creditor-paid compensation to a third-party loan originator. Compensation paid to third-party loan originators counts. That includes compensation that creditors pay the third-party originator through the interest rate. That is, if the consumer chooses lower upfront costs in exchange for a higher rate from which the creditor pays the broker's compensation is counted. If the consumer pays the broker directly, you probably already would have captured that as a prepaid finance charge. The broker's fee counts, but only once. However, for your in-house originations, your compensation to your own employee loan originator does not count for purposes of the cap. Compensation by a broker or creditor to its own individual employees is excluded under the rule.
Other parts of the points and fees definition that will be relevant for community banks are ones that you should be familiar with from your finance charges rules as well. Those are the real estate settlement costs that are often called the C7 charges because they are governed by Regulation Z 1026.4C7. These include costs such as title-related charges, appraisal fees, credit report fees, and document preparation fees. These settlement charges can be excluded from the points and fees calculation as long as they meet all 3 of these conditions. 1. The fees must be reasonable. 2. The creditor does not receive any direct or indirect compensation from the charge. And 3. The charge is not paid to an affiliate of the creditor. Here too, you have a good start from your existing policies and procedures to determine when these fees can be excluded. As you know, under long-standing finance charge rules, there's a basic requirement applicable to all of the C7 settlement charges that they can be excluded from the finance charge only when they are bona fide and reasonable. That means your compliance procedures should already have a way to determine whether those charges are reasonable. Generally, that term has been interpreted to mean comparable to that charged by other lenders in your market and not duplicative. If you do use affiliates for any of these charges, the CFPB's informal staff guidance is that only the part the affiliate retains counts.
The other 3 categories of the points and fees rule may not come up as often for community banks. Those are credit-related insurance type charges other than PMI, the potential prepayment penalty on the loan, and in same creditor or servicer refinances, any prepayment charged on the loan being refinanced. The resources we'll provide at the end of this presentation have more detail on when and how charges falling into those 3 categories need to be counted toward points and fees. We hope this segment has given you a helpful review of some of the especially relevant parts of the rule. Now let's turn to segment 7 and some supervisory and examination issues.